welcome FCPA Robert Waruiru, a partner, tax and regulatory Ichiban, tax and business advisory LLP, and that is the opportunity to get Robert and his panel, which is entirely online, to be able to engage with us, even as the paper is chaired by Mr. Japheth Ogalo, the Managing Director, Old Mutual. So I will invite us to give a round of applause to Robert Waruiru as he gets the team on this wonderful conversation. Ladies and gentlemen, a big round of applause for that. Thank you so very much. Bwana Robert, karibu, the platform is yours. Please take over and deliver your excellence. Thank you.
Thank you very much, Bwana Okari, and good morning, ladies and gentlemen. Yes, it's still 20 minutes to noon. I hope you're all well. I can see my panelists online. I see that is Zippy Chege. Welcome, Zippy. Audio team, can we have some sound for Zippy? Just I want to test the... Zippy, can you hear us?
Yes, I can. Can you hear me?
Excellent. Thank you very much. And welcome. Edna, can you hear us?
Thank you. Yes, I can hear you.
Thank you very much. And George, can you hear us?
Yes, I can hear you, Robert.
Excellent. Thank you very much. So, ladies and gentlemen, a very quick introduction of my panelists. So allow me to start with Zippy Chege. Zippy Chege is not a stranger to most of you. She is the CFO of ICEA Lion General, and has been, she's a frequent speaker in these engagements, and will be tapping into her expertise and her experience from a practical perspective. So welcome on Zippy. And then we have FCPA Edna Gitachu. FCPA Edna Gitachu is the Associate Director at PwC, and she is the policy lead. She leads in terms of these policy guidelines and interventions that we engage with government. And she will be also sharing her experiences as far as policy is concerned. Welcome on board, Edna. Then last but not least, thank you, Edna. Last but not least, we also have George Gitau. George Gitau is an advocate of the High Court of Kenya and also a qualified accountant. And he heads tax and legal at SKM Africa, which is a boutique tax advisory firm. Welcome on board, George.
Thank you, Robert.
Excellent. So in view of time, ladies and gentlemen, allow me to just go on and introduce the conversation. I know we're talking about the Finance Act 2023. That's been discussed quite extensively, and I want us to pivot a bit into just what we have seen. So Edna, the Court of Appeal, the Supreme Court have pronounced themselves around the applicability and the enforcement of the Finance Act 2023. From a practical perspective, what challenges have you seen with that pronouncement? Edna?
Thank you, Robert. So the Finance Act 2023 was passed into law on 26th of June 2023. A few days later, that's actually on 30th of June this year, the High Court of Kenya gave interim conservatory orders. So what the conservatory orders mean is that you cannot implement the Finance Act. Again, on 10th of July this year, 2023, this was all extended until the full hearing and determination of the case. So during this time, taxpayers were not expected to comply with the law. It was actually a catch-22 situation because you have conservatory orders in place, so you're required to honor the conservatory orders, and at the same time, there is a risk that if Omtata and the team lose the case, then taxpayers are going to be slapped with penalties and interest. So later on, about a month later, 28th of July, we have the conservatory orders lifted. And this means that taxpayers now had to comply with the Finance Act. The lifting of the conservatory orders did not necessarily mean that there was a change in terms of the implementation dates of the Finance Act provisions. So there are some key Finance Act provisions that were introduced by the Finance Act of 2023, which brought about a lot of practical challenges. The first one is around employment taxes. So from a pay-as-you-earn perspective, we had two new bans. We had the band of 32.5% and another band of 35%. We also had a levy introduced, affordable housing levy, and all these were effective from 1st of July 2023. And remember that the conservatory orders were lifted on 28th of July. A number of organizations had already processed their payrolls. So what they were forced to do is to have a second run of their payrolls just to make sure they are compliant with the law and they paid the affordable housing levy and also ensure that pay as you earn was paid correctly. Another challenge that we had was around the change in terms of remittance of taxes, the withholding tax, withholding VAT. So this moved from the 20th of the following month to 5 days after. So we saw a challenge where taxpayers tried complying, but the system, the iTax system, was configured in such a way that there were already penalties and interest for late payment of these taxes. So those are some of the challenges that we have seen that taxpayers have faced. Robert?
Thank you. Thank you very much, FCPA Edna. I should have indicated that Edna is a fellow of the Certified Public Accountants of Kenya, number 160. Well done, Edna. Zippy, 3 months down the road, as a CFO, what have been your practical experiences with this Finance Act?
Thanks, Robert. It's been quite a tough environment after the enactment of the Finance Act 2023. Like Edna has mentioned, so the first thing that happened is we needed then to comply with payments of withholding taxes and withholding VAT, which are now required to be paid every 5 days. So the first thing that happened is, depending on how you made or raise those PRNs, most of the players then had penalties and interest being charged on their iTax ledger. When it came to pay as you earn and housing levy, we had already paid employees and they were already enjoying the piece of their net pay. And we needed to actually comply with, the additional taxes and the housing levy. What we also found is that quite a number of our staff also then had issues with their third pay rule. And therefore, it was a conversation of how exactly do we then recover the amount that we hadn't deducted from these employees. Robert, the aspect of weekly payments of withholding tax and withholding VAT has been quite a big challenge. Previously you pay taxes on 20th and you're done. And we had to come up with internal procedures to ensure that we comply with this. The requirement is that we make these payments every 5 days. So we chose a day within the week where we are ensuring that these particular payments are being made. Accruals versus payments remains a big area of challenge, right? So we have our claim payments, which are going through the approval process. The key question is, at what point do the 5 days start counting? And when KRA actually comes to do the audit of our books, exactly how will this be interpreted and what does that mean in terms of compliance and related penalties and interest? VAT on insurance compensation. I think that's the hottest issue on the table. Do we even understand which of our insured are registered for VAT? Exactly how is this being understood? We have received communications from some of the brokers asking, should even the sum insured amounts now change as a result of this requirement of VAT? Initially, it did appear like a very simplistic or easy to apply requirement. But what we've actually found as a business is that it's important for us to reach out to a professional firm to actually review the various aspects of VAT on insurance compensation and ensure that we are not left holding the wrong side of the stick. Lastly, Robert, we have the whole aspect of corporation tax, and that only expenses that will have gone through teams will be deductible from 1st of January 2024. So of course, some of us have rental income. We had an element of teams in it, but then it also means that we need the entire business reconfigured to ensure that our expenses are going through the teams application. So that's a must do for all, I guess, everyone operating in this country, including the insurance players, to then ensure that, you know, our debit note and whatever it is actually going through that particular process from 1st of January 2024. And probably I could stop there. Thank you.
Yeah, thank you, Robert. So the Finance Act 2023 introduced a new provision, basically providing that there shall be VAT on insurance compensation, and basically this will effectively apply, you know, when the risk crystallizes and there's a payout to an insurer, to an insured person. And the question really at the beginning when we when the position the law first came into place was, you know, how will this apply, and who would have the obligation to actually cater for this. And you know, now the challenge now is coming in with the insurance companies dealing with having to identify which of their insured are actually registered for VAT, who will then be able to account for this VAT on insurance compensation. So I think it is one of those new provisions that really, you know, a lot of guidance will be required from the Revenue Authority to be able to ensure proper implementation. Thank you, Robert.
Yeah, so Robert, in my view, I don't think there would be a withholding VAT obligation. And just going back to the facts of this law and what exactly it was intended to cure. So the intention of the law was, if you as the insured had actually claimed your input VAT, then that is being clawed back at the point when you receive your compensation. Zippy talked about the practical challenge that the underwriters would be having. They have no way of finding out who exactly is this who had claimed their input VAT or not. So in my view, the responsibility then shifts to the insured, because the insured is the one who is registered for VAT. The insured is the one who would know whether or not they claimed input VAT. So when it comes to payment of compensation, because the insurance companies have no way of finding out who did and who did not claim the input VAT, in my view, the obligation of withholding VAT should then not arise. This should then be a self-declaration on the insured's part. But another practical challenge that the insured will face, as Zippy said, you're now required to issue all the invoices. All your VAT transactions are supposed to be done electronically. So the practical challenge that is going to arise is, yes, as an insured, I claim that VAT, it has now been clawed back, but am I going to issue to myself an electronic invoice so that I am able to account for that VAT, or what exactly is supposed to happen? So as George is saying, I do agree, this is one of the areas of the provisions of the law where we do expect a lot of guidance from the Revenue Authority. I am aware that the Revenue Authority has written to the Association of Kenya Insurers, indicating that the responsibility is actually on the insured and not on the insurance companies, but at the same time encouraging the insurance companies to talk to the insured. So I think a lot of conversation is required around implementation of this particular provision of the law. Robert?
Thank you very much, Edna. And so, ladies and gentlemen, if there's one thing that we take away from this discussion is that come 1st January 2024, all your invoices have to be TIMS compliant for them to be acceptable as expenses. So allow me to just move on to the medium-term revenue strategy. And I know this is a public document that has been up for debate, and the public participation closed on Friday last week. And I just want us to quickly delve into the provisions of, we call it the MTRS, Medium-Term Revenue Strategy, number 2. Edna, let me start with you. Very, very briefly, in under a minute, what exactly are we looking at when we talk about MTRS 2 from mathematics perspective?
Yeah, so Robert, just for purposes of those who are there in the conference, just allow me to explain what exactly is an MTRS, because the chair of the finance committee talked about the national tax policy. So if you're to look at the hierarchy of documents in a country, we'll start off with the economic blueprints. In our case, that is Vision 2030. To be able to implement Vision 2030 from a tax perspective, the national tax policy should then read from the Vision 2030. Our national tax policy is a long-term document. How then do we break it down in a way that we can be able to implement the national tax policy? So below it, you then have the medium-term revenue strategy, which is basically supposed to help us in the implementation of the national tax policy. And we see, like in Kenya's case, this is divided into 2 phases. You have one phase that will go up to 26, 27, and then thereafter up to 2030. Quite a number of objectives have been envisaged in the medium-term revenue strategy. One of the things that we have been struggling with as a country is after we rebased our economy, our tax to GDP ratio reduced significantly. So we are currently at around 15%. So what the medium-term revenue strategy is seeking to do is then to increase our tax to GDP ratio from the current 15% to about 20% by 2027, and then thereafter to 25% by 2030. So how are we going to go about increasing our tax to GDP ratio? A lot of things are coming out of that. So the first thing that I see is that there's this tension between the direct taxes and the indirect taxes. There's a move to reduce the direct taxes. That will be their corporate income tax and also your personal income tax. So the rates, the top marginal rate for the personal income tax is supposed to be aligned with the rate of the corporate income tax, and both of them will be at 25%. But at the same time, we are talking about harmonization of our VAT rates. And currently within the East African community, Kenya has the lowest rate. So this means that most likely then our VAT rate is going to go up. So we already seen that tension and the trade-off between the direct taxes and the indirect taxes. Another area we are seeing is expansion of the tax base. We have really been talking about expansion of the tax base. What we suffer as a country, and not just Kenya, but all the developing countries, is that we have a very narrow tax base. So we have been deepening the tax base, and the same taxpayers have been subjected to multiple taxes. So we are seeing attempts to also expand the tax base. And finally, I can talk about management of tax expenditure. And this is where exemptions fall into place. So for instance, from an insurance perspective, one of the incentives that you have is that if I buy an insurance product, then I get insurance relief. But we are seeing in a bid to expand the tax base, what the medium-term revenue strategy is spelling out is that let's do away with all these reliefs, with all these incentives, so that we can collect as much as possible. There needs to be a very delicate balance where this is concerned, because you might think that we are doing away with this to increase revenue, but unfortunately, you achieve negative results. So these are some of the broad thematic areas that I see, in addition to also increasing the compliance levels. Currently, the compliance levels in the country at around 70%, and we want to increase this as a country to 90%. But allow me to say this, Robert, I'm already seeing a few contradictions between the national tax policy and the medium-term revenue strategy. So we need to have these documents aligned. Robert, back to you.
Thank you very much, Edna. Thank you for those thoughts. And allow me to just cross over to George. George, so we've had the broad thematic areas, and one of the key ones, perhaps for delegates here, is 25% corporate income tax. And that is certainly lower than the Africa average of about 28%. And interestingly, Rwanda has implemented its first medium-term revenue strategy and committed to reducing its corporate income tax rate to 28% in the short term. And effective 14 September 2023, they did actually reduce their corporate income tax rate to 28%. What are your thoughts around that, George?
Yeah, so I think the move to reduce corporation tax rate will definitely, or is definitely aimed at, first of all, attracting investment into Kenya. Basically, a lower rate would achieve that. The second point would be perhaps to, reduce profit shifting, which is basically companies or investors creating structures to ensure that they are taxed in jurisdictions where there are lower tax rate. So effectively, this then would position Kenya in a way to basically attract investment and remain as a key investment destination. We're already seeing a lot of FDI in the tech space and all that, and perhaps this then would basically assist in growing that.
Thank you, George. Just a quick follow-on on that. Do you see, given that employees are probably paying 35% tax and companies will be at 25%, do you see a risk there from a tax arbitrage perspective?
Yeah, definitely, Robert. Kenyans are never left behind with, creativity. When you have one rate for employees being 10% higher than the company rate, then perhaps maybe people might structure their affairs to achieve that. But even good that you touched on the issue of employees. It's been argued that when the corporate tax rate has an impact on actually the money that companies have, which they can pay to employees. So perhaps then it might create a lower corporate tax rate might even end up creating more opportunities for employment because now companies will have a bit of freer capital based on the lower corporate tax rate.
Excellent. So that creativity is around tax planning and tax optimization, I believe, which is not a bad thing. Zippy, MTRS2, there's a very interesting proposal there around VAT on insurance. What are your thoughts around that?
Robert, allow me to start by saying that it's a sad proposal. And I think the last engagement we actually had with the Institute, I did make the comment that my greatest fear is when VAT is actually introduced for insurance services. Yesterday, a team of CFOs in this industry that I lead actually tabled, a document ahead of the finance committee to actually put the point across that if VAT is actually levied on insurance services, it's going to be detrimental to this particular industry. I couldn't agree more with the director of the Institute when she was talking about how we are perceived. And unfortunately, that's exactly what we meant as we were trying to make this proposal. We are seen as an industry that does not meet their side of the bargain. And therefore, it becomes very difficult to say that if we introduce VAT on insurance, it will impact our insurance penetration. Some of the viewpoints are, you've not had it. Why has the insurance penetration remained at 2.33%? So this is going to significantly impact our industry from a cash flow perspective. We are hoping that some of the products, especially for the life business like pension, can be excluded from this provision. It's almost impracticable where you have long-term contracts to actually have VAT loaded on top. But just borrowing the words of the director of the Institute, she did say and make the point that actually 65% of our industry product is medical and motor because it's mandatory, medical because most likely these are people who are employed and their employers have actually provided this particular benefit. So if we add VAT on top, it actually means that we have a higher chance of actually shrinking the industry because insurance is not a basic need. It's what we do after we have put our food on the table. And therefore, the call for us as an industry is first, we need to change the perception. We need to clearly articulate the value that we bring to this economy as an industry. And as a result, also be able to push forward the fact that the introduction of VAT in this industry is actually going to be very, very detrimental.
Thank you very much, Zippy, for that. And perhaps I can just bring in Edna here. Since 1990, we've never seen that when the VAT Act came into place. We've never seen that kind of a proposal. We obviously saw excise duty coming in 2012, 2013, and then dropped off in 2015. Any additional thoughts?
Yeah, so Robert, the first additional thought I'd want to give, in addition to what Zippy has said, when we're introducing some of these taxes, we also need to think about the ripple effect in the economy. So when I go and buy a long-term insurance product, say I'm assuring my life, as an example, what will happen is that I am paying this premium, say on a monthly basis. The insurance company is going to accumulate this money from Edna and other people whose lives are also insured or assured, and then this excess money is going to be used to buy government securities. So it's a known fact that the insurance sector also contributes significantly towards the purchase of government securities. So the moment now we say, let's introduce VAT, that means that it's going to become more expensive for Edna and other people to buy this, and we'll start thinking twice. So the premiums are also likely to go down. And if this then happens, a ripple effect is that even the subscription of the government securities are likely then to go down from an insurance perspective. But having said that, again, I think we need to have a trade-off between this VAT and excise duty. We have been having excise duty on financial services. So if we are thinking about this conversation of introducing VAT, in my view, it cannot be both VAT and excise duty. It has to be either or the other. But having said that, we have seen VAT in other East African community member states. So for example, our neighbors, Tanzania, Rwanda, Uganda, they have VAT on insurance. But what they have done is that they have ring-fenced certain classes of insurance. So you'll find in certain instances, part of the long-term insurance is safeguarded. That's your life assurance is safeguarded. If you go to South Africa, we do not have VAT on long-term insurance. Uganda doesn't have VAT on health and life insurance. They have also extended it to the agricultural sector. They also don't have VAT on that, and the insurance sector as well. Rwanda doesn't have VAT on the agricultural sector, which is also similar to what we see in Tanzania. So we need to think through this and say, what are some of these classes of insurance that need to be safeguarded? Again, in my personal view, if you're talking about short-term insurance, and this is the one business to business, what we call B2B, I would expect that most of these businesses would be then in a position to be able to claim this input VAT, therefore making insurance premiums affordable to the general public. So if we are saying that this insurance, the VAT on insurance is only going to apply in B2B transactions, then perhaps we can then say, maybe we can listen to that, but we then safeguard these other classes of insurance so that the final consumer is also able to afford insurance. Robert?
Thank you very much, Edna, for that. George, any quick comments before we move to the next question? And ladies and gentlemen, please feel free to prepare your questions. We'll have a session to address that. George?
I think, Robert, for me, just a brief comment on, in 2020, we had seen an introduction of VAT on brokerage commission. So the exemption had been removed, and, the Association of Kenya Insurers, went to court to challenge that. So what my thoughts are is, as we, the MTRS talks about insurance services. So we are not clear whether then we will be saying we're introducing VAT on, the premiums as well as the commissions charged by brokers and agents and all that, and how that really the interplay will be, because if on one hand then we say premiums will be subject to VAT, and brokers and agents commissions will be exempt, then that actually leaves the insurance company at a disadvantage, because they will not have a chance to claim any input. So maybe that would be my thought around that issue.
Thank you very much, George. And I can see Zippy is nodding very vigorously and agreeing with that. Zippy, that medium-term revenue strategy, and you can give us your additional thoughts on that, but that medium-term revenue strategy is also talking about motor vehicle circulation tax and carbon emission tax. And you talked about motor and medical accounting for about 65% or so of the insurance, the GWP. What are your thoughts about these additional levies that are coming in?
Thanks, Robert. So when we look at motor vehicle circulation tax, it's defined as a wealth tax. Okay, so the fact that you're driving, you're wealthy, and as a result, you should get something little on top of it. So that's the first thing that we need to address. Is owning a motor vehicle in this country a sign of wealth? How efficient are our public transport systems? If you go to other countries, you're able to efficiently move from one place to another without a lot of struggle. So the definition of wealth there, in my perspective, I think is a bit skewed. Secondly, it's supposed to be implementing by having a minimum tax for everyone paid at the point of getting insurance for a motor vehicle, and then a graduated scale based on the capacity of the vehicle. And I think in that graduation, probably that's where the definition of wealth should be coming in. We probably need to have a minimum CC capacity where we say, this is basic. But to the extent that you're able now to afford this particular level of CC, perhaps then we could introduce that particular tax. With respect to carbon tax, I think this is a welcome move. There's a whole move towards ESG and moving to net zero, and we all have this commitment as a country. And so I believe that, we should support this particular aspect. However, what are the policies in place for us to start transitioning into electrical vehicles? If we are still allowing these other vehicles to be imported into the country, and that's largely what is in the circulation, then how effective is this going to be? Now, is this likely to impact the overall top line we see for motor? We buy motor insurance because we must. So it's increasing the price of our motor private insurance. Will it have an impact? I would say absolutely yes. Every rational consumer will have to ask, if I have to pay comprehensive insurance, on top of it I have to pay carbon tax, on top of it I have to pay motor circulation tax, then probably I don't need comprehensive, or I can't afford comprehensive cover, let me just go for the mandatory third-party cover. So I think there are quite a number of aspects coming through that will impact our industry, and it's our time to come together, look at these things, and give out our voice on what it is that we feel this will have an impact on this particular industry. Over to you, Robert.
Thank you very much for that, Zippy. Likely to have an impact. Edna, allow me to just come to you and perhaps even as you answer that, any additional comments to that. I want you to also address the issue of levies. We've seen quite a number of levies coming in. What is your view around the number of levies versus the tax policy direction in this country? Edna?
Yeah, thanks, Robert. So allow me to first of all chip into the question that you had earlier asked to Zippy. So I said earlier on that one of the challenges I'm seeing is that some of the taxes introduced by the medium-term revenue strategy are not in the national tax policy. And Zippy has talked about wealth tax. It's not there in the national tax policy. We also have the concept of minimum tax coming back. It's not there, and carbon tax. So I think the first call would be, can we first align these two documents? And then we define what exactly are we trying to achieve by the introduction of these three taxes. When you talk about wealth tax, wealth is manifested by the income. So accumulation of income is what gives rise to wealth. And if you think about the incomes that we earn, the various income streams, they are already subjected to tax, one form or another of taxation. So I think fundamentally we need to think through and say, is this a strategy that we want to pursue as a country? This has been tried in other countries, but sadly, what we have seen is that the amount of tax realized has been very minimal. We've also seen, especially around the OECD countries, I think right now it's about 5 or so countries have the wealth tax. They're not realizing much tax revenue out of this. What are the negative economic consequences of having a wealth tax? One is that you're going to hinder accumulation of wealth. So this is going to result into capital flight. So maybe this is an area that needs to be looked into so that we can see, is it going to encourage investment into the country, or is it going to discourage people from investing into the country? Then now on to the question that you have asked me around levies. I do agree we have very many levies. If I'm just to give a few examples, when you import anything into the country, you have your railway development levy that you have to pay. You also have your export levy on certain categories of foods that are exported outside the country. The Finance Act 2023 introduced the Export and Investment Levy. We also have levies arising from petroleum products, and these levies are quite a number. And we have the newly introduced affordable housing levies. So I think we need to start reviewing these levies. I do appreciate that these levies are charged to fund specific initiatives, but these levies at the same time are increasing the cost of doing business in the country. And so if we want to remain attractive as a country, we need to then ask ourselves, how can we bring down the cost of doing business in this country? And specifically, if you're looking at the tax-based erosion, as your question alluded to, so you'll see that from the person contributing, if this is a corporation that is paying to this, then this would be allowed for tax purposes from an income tax perspective. These levies would be allowed. So again, there's an issue there because the taxman, and if you look at the medium-term revenue strategy, we can see the voice of the taxman, where the taxman is saying, you eroded my tax base, and therefore I am getting less tax than I would have gotten because of these levies. Let's flip it the other way to the employees. Look at affordable housing levy. When you're contributing this affordable housing levy, it is not an allowable deduction. So what does this mean? It means that you're going to pay, you pay as you earn on the full amount, including that affordable housing levy. So I think one of the points that maybe should be considered in the next financial cycle, finance bill cycle, is that for employees, this should also be an allowable deduction so that we are increasing the disposable income of employees. And for employers, there's that tension. We definitely need to think through, can we rationalize all these levies that are coming through? They're quite a number, and we want to make ourselves attractive as a country so that we keep attracting foreign direct investments into the country. Robert, back to you.
Thank you very much, Edna. And I'll request whether George has got any additional thoughts about that. And George, even as you answer that, there's been a general view in the market that Revenue Authority is not up to scratch in terms of the caliber of professionals that it's sending. And the medium-term revenue strategy talks a lot about that. What's been your experience, even as you add on to what Edna said?
Yeah, I think Robert, in the past, KRA had put in place a proper kind of training structure for its recruits. We had a 2-year training program, which really just ensured that officers being deployed were actually up to scratch with the tax administration and even the legal issues. I think that was scrapped, and what we've seen in the recent past is sometimes you can interact with officers who might not be able to appreciate some of the more technical issues, especially in the smaller for the smaller taxpayers when you're discussing a technical issue, and you will find that the officers in place are really not very well up to speed on some of the matters. But we're happy to see that the graduate recruitment or graduate trainee program for KRA is coming back, which we expect now will bring back the training program to assist government, because if the officers are not properly trained, then that has an impact on revenue collection and even identifying some of the tax risks as they carry out their audits. There's the deployment of I don't know what word to use, the trained NYS officers, or who I don't know. I think taxpayers have also just raised a question. Obviously, that is new, but taxpayers have raised a question. These officers have been trained for 3 months, and then they are coming now to ask questions or do audits, and questions around capacity, especially from a technical perspective. Yeah, back to you, Robert.
Thank you. Revenue service assistants, I think, is what they are formally referred to. All right, ladies and gentlemen, we can discuss tax until the cows come home. But in view of the limitation in terms of time, I just want to find out whether there is any quick question from the audience before I invite my panelists to make their closing remarks. Any quick question? Yes, there's a gentleman right there. Okay, so shall I work the microphone there? Okay, let's start with this gentleman who is right here next to me. Will that one work?
Okay, thank you. Good afternoon. My name is Sylvester. Now, one of the key incentives that has been used by insurers over time to try and get life assurance policies moving, both in product design and also to incentivize customers, has been the incentive around the tax, that percentage that we have. Now, as we go through the laws that are coming in and the tax issues that are coming in, have they considered the implication that it would have on product design, the existing policy structures, and the overall just uptake of, say, life assurance products in the market?
Okay, thank you very much, Sylvester, right?
Right.
All right, excellent. Thank you very much. That's a question on design. I think we can have Zippy or Edna respond to that. I think let's take the other question so that we can address the two of them.
There's a question from that end.
Yes, my name is Joel, and just want to get more clarification on the VAT on insurance compensation. Now, one, is it on insurance compensation or insurance claims? Secondly, I would like to understand what really is the intention of the taxman here, because I speak from the general insurance bias, non-life. And in my view, there's something that Edna mentioned, which in my view is not really a problem. I think the underwriters have no problem of identifying whether their insureds are VAT registered or not, because of the simple reason that every non-life claim, majority, let me not say every, but of course, any significant in terms of the claim amount, most of those claims are adjusted by loss adjusters. And every loss adjustment report must indicate whether the insured is VAT registered or not, or exempt, or whatever it is. It has to be there. So an insurer has no problem to know whether the insured is VAT registered or not. So, assuming therefore that the insurers are able to know whether their clients are VAT registered or not, then I don't see the problem, except the issue will now be, because currently, or before this particular amendment, what has been happening is that the loss adjusters will pay, or will advise the insurer to pay net of VAT. That has been the practice. Net of VAT payment is made. So I would like to know if then the VAT will be taken into account, then does it mean that underwriters probably need to capture the VAT aspect in the sum insured? Because it appears that before then, the sum insured was not part of the sum insured. I mean, the sum insured had no component of VAT because it has always been deducted.
Very well.
Yeah.
There's a question online. As we look into that, I'll quickly delve into comment from the former director, Agnes Macharia, saying to the team, well done for the excellent insights. To ZP, this is to you. How do you think the insurance industry stakeholders, leaders, can collaborate with the insurance financial professionals in order to have their ears on the ground to foresee and predict issues likely to affect the industry adversely and be proactive in dealing with these issues before the law is passed? ZP, I believe you got that. And then we have William Kiama online also saying, when we start looking at our neighbors, at what our neighbors are doing, and in the past they have been borrowing from us, what does this mean to us? I believe that one is where we will leave you to answer and give parting shots within the next 3 minutes, and then we can proceed to close that.
Thank you, MC. My panelists, as you answer the questions, please also give your closing remarks so that we can try and manage time. I think we can start with Zippy.
Thank you, Robert. I'll be pretty quick. Let me first pick the question around insurance compensation and what this means. I think the complexity comes in. For example, when a vehicle is valued and we are told that a vehicle is worth 4 million. What is that 4 million? Is it the amount someone can actually go, because of the indemnity principle, go and be able to buy a vehicle, to restore them to the position where they were before a claim actually occurred? So there's a whole debate about what is the sum insured. Was it with VAT or without VAT? Is this supposed to cut across equally amongst the various claim types? Or what sort of conversations do we need? I think that's where the complexity comes in. And as correctly mentioned, yes, we have loss adjusters and they make various comments around VAT. How about those claims where it is not clear? What does that mean? And so from where I stand, I think every insurance entity needs to look at this issue a bit more critically. Because even if we tick the box from a tax compliance, are we likely now to also see our insured coming forth and disputing how we are actually interpreting this particular perspective? In terms of collaboration with other financial professionals, we have the Insurance Institute of Kenya, which has done an amazing job. I've really enjoyed the conference for the part that I've been in this morning. We have ACI, we have the Insurance Regulatory Authority. I think, borrowing a leaf again from the banking industry, we have a long way to go first to speak about our industry, to speak about the value that we bring to various policy holders, so that even before these things are documented and then we are trying to work very hard to remove them, we have already painted the correct picture. So a collaboration between IRA, ACI, the industry itself, IIK, etc., we really need to come together and collaborate. And even from a financial services sector, how, for example, do we collaborate with the Banking Association? How are we ensuring that our voice is heard and therefore we are speaking from one particular perspective? My parting shot would be IFRS 17 is effective 1st January 2023. It will have tax implications. We have no view what KRA has to say as far as this standard and the tax implications. It's incumbent on us to start engaging the tax authority as early as now, so that then we ensure as an industry we are well guided on how to handle IFRS 17 as we prepare our tax computations early next year. Over to you, Robert.
Thank you very much, Zippy. IFRS 17 is a monster. I can tell you that. It's even for us accountants, it's a bit of a nightmare to understand. Edna, very briefly, any additional comments as you close, as you give us your closing remarks?
Yeah, so Robert, I lost connection at some point, but I can see there is something. I got connection when the MC was reading out the last question. When we start looking at what our neighbors are doing, and in the past they have been borrowing from us, what does this mean to us? So my view is benchmarking is not bad, but I think what William is trying to suggest is that more often than not, we are ahead of our neighbors. So we probably need to see who are we benchmarking against. And one of the reasons why we talked about the statistics for our neighbors was around this whole question of VAT. If we benchmark with other more developed countries, such as the United Kingdom, they have the similar model that we have currently, where insurance is actually exempt from VAT. So the question is, as we benchmark, what practices are we going to bring on board to take us forward as a country? And what practices should we then leave behind so that we are only taking the good and making sure that we are growing our economy? In terms of my parting shots, I do agree with what Zippy has said. And just to paint the picture of what is likely to happen next year in terms of tax compliance. So you have your IFRS 17, you're preparing your financial statements according to IFRS 17. The provisions of the Income Tax Act have not been amended, and they are largely based on IFRS 4. So it is likely that you'll have to prepare two sets of accounts, one under IFRS 4, so that you're able to determine your tax liability, and one under IFRS 17. I can only imagine the nightmare trying to reconcile from IFRS 17 to IFRS 4. And to the point that George had earlier talked about around capacity building, the question then is, does the Revenue Authority understand what this IFRS 17 is all about? We probably have equipped ourselves as an industry. We have been talking about IFRS 17, but we need to take this conversation to the Revenue Authority, to the policy makers. Let them understand so that they can see the administrative burden that we are going to be facing by having to maintain two sets of accounts, so that we can move in tandem with what is happening. We change the provisions of our law to comply with IFRS 17. And the final comment that I would like to make, Robert, is that as a sector, we cannot afford to keep quiet when the tax landscape is changing very rapidly. The economy has changed. The way we are doing business is changing very rapidly. Let's keep talking. Let's talk to the policymakers. I was glad when I listened to what the chair of the finance committee said. Let's engage these people. Let's tell them more about this insurance industry. And then let's also be the pioneers of forging or bringing into place the tax policies that are going to propel the insurance sector to the next level. Thank you very much, Robert.
Thank you very much, FCPA Edna. And last but certainly not least, George, and perhaps as you give your closing remarks, you can just quickly talk about the question by Sylvester's around the design of some of these products, given the reduction of the reliefs. George?
Yeah, thank you, Robert. I think definitely if the government were to go ahead with the MTRS proposals to review the reliefs, and especially the insurance relief, that will definitely have a significant impact because there are many people who actually take up some of these products, hoping to even benefit from some of these reliefs. Even the issue of VAT will obviously affect product pricing and product design because definitely now that has to be factored in determining what products are being offered to the public. And by way of closing remarks, Robert, I think the one thing that I've received feedback on, from taxpayers, especially those coming from other jurisdictions, is usually the lack of certainty in our tax policy. And we're now seeing the government rolling out the national tax policy and now the MTRS. And I think for me, what I hope to get out of this process is for taxpayers to have a bit of certainty on tax policy and changes coming in. This MTRS, for example, I think, and using the insurance industry for context, I think it tells you what government is thinking about. And now, as Edna has said, industry lobby groups then have to go ahead. Don't wait for the Finance Act to come. Start having the conversation, especially on the big issue that is VAT on insurance services. This now tells you government is thinking about it and it is coming. We always knew, government is thinking about it, but now we have it in a document. So perhaps then now it is the time to engage and try and see, whether the industry can get ahead of it, because it might be, based on a misunderstanding of how the industry works and all those, and perhaps providing that clarity might make it easier. Thank you, Robert.
Thank you. Thank you very much, ladies and gentlemen. That was Zippy Chege or Zipporah Chege from ICEA, CFO at ICEA Lion General. Edna Gitachu, Tax Policy Lead at PwC and Associate Director. And George Gitau, Head of Tax and Legal at SKM Africa. It's been a very, very good conversation. Asanteni sana. We'll keep on engaging, and clearly there is a lot to engage government in terms of policy as far as tax matters goes. Asante sana. Thank you.
Thank you. A big round of applause for